You know, I look through this new playbook from you, and it comes across as pretty cautious. Is that fair?
Yeah, I think that as we move into this late cycle environment, the ability for, double-digit stock returns are going to become increasingly difficult. And so we're really looking at RV trades and relative value positioning in order to be able to generate, real returns in this environment. And I think there's a real clear bifurcation that has developed in the market and will continue to unfold as the months and quarters progress.
Yeah, I mean, are you in the Griffin and Tudor Jones camp? Ken Griffin can't think of a worse financial environment since we're in perhaps the highest period of uncertainty since the great financial crisis, is what he said. Tudor Jones, you don't want to own bonds or stocks. It's going to be a very negative situation for either one of those. You can't think of a worse macro environment than where we are now. Now, look, they're luminaries. It doesn't mean they're always right or going to be right this time, but nonetheless, that seems to be a prevailing view from big money.
I don't think that the market, and I don't think investors should be that dire in terms of their market outlook. Still we're in an environment where growth is probably going to remain above trend. I don't think that we're going into a recession over the next 12 months. But when you're coming off double-digit returns every single year in and year out, and we're 60-40 funds were delivering 10% on an annualized basis. And, now the outlook is maybe low single-digit returns. That's, a pretty big deceleration. And so, yeah, certainly the outlook is much more uncertain than it has been, in a long time. That said, there's real pockets of opportunity still within stocks. And when you look across the stock market, they're still beating, first of all, in the first quarter by about 4% on average. They're still delivering, really solid results across the board. Now, there are certainly names that we've seen, real big misses and their stocks have gotten punished. But you look at reopening names, you look at some of the reflation trades in the market, there's, I think, real opportunity for outperformance, continued from names like reporting today, like you mentioned, like Airbnb and Expedia and the other travel, names, which, today obviously got hit and came under pressure. But I think as we go forward over the next couple of weeks, you're going to continue to see really strong bookings numbers, really strong reopening trends, and stocks like that continue to work.
At the same time, though, you're picking things like healthcare and pharmaceuticals, maybe with a little more defensive bent and favoring less cyclical exposure. Now, I obviously know why the travel names are going to work. That's no big shock. As you said, we're reopening the economy fully, and people want to get out there this summer and do that. But you definitely do have a more defensive tone.
Yes, absolutely. And I think as you move into that late cycle environment, the tipping point for recession gets closer and closer. And so you do want to be broadly defensively positioned in your portfolio. We're not looking at, broad cyclicals to outperform from here, outside a couple of, key sectors and names, nor are we looking for value to outperform. We're really looking for quality and looking for stocks that can do well in lower earnings visibility environments and overall have lower earnings volatility. And, more of the defensive sectors, particularly healthcare, which is, I think quite attractively valued, really looks, I think, quite good right now. I also think the tech sector, which has gotten punished this year, large cap tech, not, the tech that is not profitable, but large cap tech that has good free cash flow generation, high cash sitting on their balance sheet, also can, perform well as a defensive in this market environment. And the valuation here looks really attractive.